Hey, it's Mark Ferguson with Investor More, and we're back with another real estate slash economic video. Today we're talking about inflation, and I really wanted to do this video because I feel like I have a completely different viewpoint on inflation than pretty much anything else you hear out there. And I'll talk about why I actually feel raising interest rates causes higher inflation, not lower inflation. So we'll go over what kind of the common ideas are about rates and inflation. I'll show you a study that actually agrees with me. We'll talk about some other countries and inflation, and then the whole core thesis behind why I think that, and using it in a logical sense in regards to inflation. So inflation is, important to all of us. It makes our costs rise. It usually makes interest rates rise, makes mortgage rates rise. I'm a real estate investor, do flips, rentals, have a brokerage, and rising interest rates affects me directly. So it's important to me. It affects the real estate market as well. And I think it affects the general economy, and especially now in where we see inflation because of supply chain issues, low supply, high demand, gas prices, energy prices. It seems like raising rates, at least logically to me, is not what is going to lower inflation. And I'll talk about why I think that and try to back up some of it with my thoughts and data that I've collected. Now, of course, we love the likes, shares, comments. Keep those coming. Love seeing new subscribers. Most of my videos are real estate walkthroughs on our flips, rentals, and advice videos on that. But once in a while, we get into the economic stuff as well. All right, so what is the basic premise that you normally hear about inflation and interest rates? Well, first off, inflation is basically, the prices of goods going up, right? Your food goes up, your gas goes up. If you normally pay $10 for something, if interest rates go up 10% in 1 year, then that means you're paying $1.10 for that something the next year. So those rising rates make things more expensive. When inflation goes up, usually wages, the cost of everything goes up as well. But many people feel inflation is very bad, has to be controlled, and they're willing to risk the economy, jobs, all kinds of things to curtail that inflation and keep it in check, which is also something else to consider, is if it's worth destroying the economy, causing unemployment, causing recessions in order to slow down inflation. So that's something else we may not get into too much in this video, but that's something to consider as well. So I'm on Investopedia right here, how interest rates affect the U.S. market. All right, and if we scroll down here, the effect of interest rates on inflation and recession. So I'm just going to read a little bit. Whenever interest rates are rising or falling, you commonly hear about the federal funds rate. This is the rate that banks use to lend each other money. It can change daily, and because this rate's movement affects all other loan rates, it is used as an indicator to show whether interest rates are rising or falling. These changes can affect both inflation and recessions. Inflation refers to the rise in the price of goods and services over time. It is a result of strong and healthy economy. However, if inflation is left unchecked, it can lead to a significant loss of purchasing power. To help keep inflation manageable, the Fed watches inflation indicators such as the Consumer Price Index and the Producer Price Index. When these indicators start to rise more than 2 to 3% per year, the Fed will raise the federal funds rate to keep the rising prices under control. Now, important little lightning bolt. The federal fund rate influences the prime rate, which is the base rate from which other interest rates are determined, such as mortgage rates and the rates on personal loans. So the Fed rate is not exactly what mortgage rates are. So we saw the Fed funds rate rise earlier this year, just a little bit, and mortgage rates shot from like 2 to 5. They even got up to 6%. That's a massive increase and not really tied directly to the federal funds rate. Banks were anticipating the federal fund rates would keep going up, and so they just shot their rates up. Rates have actually come back down. In fact, a week or two ago, they were below 5 again. Now they're right around 5, a little above last time I checked. So rates aren't crazy high historically. I mean, 5% is still an amazing rate if you look at the history of interest rates, but it's much higher than it was last year, earlier this year, when it was 2%, which were just record low rates. But the federal fund rate is not directly tied to mortgage rates. So we saw the federal funds rate rise again in late July, but mortgage rates actually went down after that because banks were assuming it would rise. They knew it was coming, and it's not tied directly to that. In fact, it's often tied to the, I think it's the 10-year treasury, bonds, other things like that, more directly than the Fed funds rate. All right, because higher interest rates mean higher borrowing costs, people will eventually start spending less. The demand for goods and services will then drop, which will cause inflation to fall. A good example of this occurred between 1980 and 1981. Inflation was at 14%, and the Fed raised interest rates to 19%. This caused a severe recession, but it did put an end to the spiraling inflation that the country was seeing. So what they're basically saying is inflation was high. They jacked up interest rates really, really high. They caused a recession, and because nobody could afford anything, they stopped buying stuff and prices fell. But actually, prices didn't fall. They just stopped going up as high. Now, raising the rate doesn't always mean that prices will fall or drop. It just means they'll stop increasing as much. So we can look at this by seeing some charts. All right, this is the Fred, St. Louis Federal Bank data, really good data. They usually get this from all kinds of great places. But the blue line we have here is kind of the consumer price for the United States, which is basically inflation. And you can kind of see it going up and down here. I'm probably making it hard to see with my cursor. I'll take that away. And then the red line is the federal funds effective rate. So you can see what we were just talking about. In 1981, inflation jumped up to there, and the interest rates kind of followed it, right? As soon as inflation kept going up, they kept raising rates. And then they raised rates to 17. Inflation dropped. They dropped rates. They raised rates again. I don't know why, because inflation was dropping, but you can see from about, let's see here, that's we're talking about, that's 4% inflation, right? Most people think that's too high. From 1967, all the way, it dropped down below 4 just for a touch, all the way to, let's see, oh, it's about 3, 1992 or so, inflation was above. So we can see here from, if we look at this little chart, the blue, it gets on there. But anyway, about 1968, and then it dropped down maybe below 3 again. So you could even say from 1970 all the way to 1983-ish, inflation was above that 4% most of that time. And that whole time, they were raising rates. You can see they were pretty low here, pretty low, and then they just shot up, and you could make the argument, hey, we raised rates significantly, then inflation dropped. Inflation went up, we raised rates significantly, then inflation dropped. Again here, but then look at this. They'd raise it, and they'd raise it, but as we get into the future here, look how much more stable inflation is. And we saw them raise the Fed rates here, didn't really do much for inflation, raised it again, dropped it, not much happened, dropped it more, raised it again, not much happened. Then we had a big drop of the recession. And then we've had rates at almost zero, except for a little bit of time. And in my opinion, if low rates caused inflation, why didn't we have inflation from 2010 all the way until 2022, basically, with almost an effective rate of 0 that whole time? It did jump up to 2 here for a while. Inflation was below 2 almost that whole time. Yet rates were almost nothing. And we had a really good economy, no real recessions in there. Things were increasing, but we didn't have inflation, which is kind of weird, which makes me think maybe it isn't just rates. Maybe it's not just the economy doing well that causes inflation. Maybe it's other things. Now, I know some people think I'm crazy. I'm just showing you some graphs and trying to show correlations and different things. But my whole point is pretty much the whole basis for rising rates causing inflation to drop are kind of those charts we saw and just correlation saying, look, inflation went up, then it went down, and the rates were doing the same thing, so that kind of proved it. But was there causation there? Rates in the, let's see if I can find it. There we go. I found it on my first try. World War I caused massive inflation, right? Government spending money, printing money everywhere, just buying all kinds of stuff for war, massive inflation. It went down when the war stopped. World War II, massive inflation. Government's printing money, spending money, trying to win a war, and we had inflation. Then inflation dropped down, jumped up again. And then, look at that. It was almost at 18%, way higher than it ever got in the 80s. Went down pretty quick. They did not raise rates in the 40s. They didn't do it. They let the market take care of itself. They did implement some price fixing, but I don't know how effective price fixing was. That means, the government says, hey, if steak costs $10 this year, it's going to cost $10 next year, no matter what your costs are. And what happened was you saw companies say, okay, well, I can't make money because my costs are going up. So instead of using cows, we'll use horse meat. Or we'll make an 8-ounce steak weigh 5 ounces. Well, we have to cheat to make it work because if we don't make money, we can't be in business. You can't fix our prices. And as soon as those price fixes are lifted, prices shoot back up to where they should be anyway. So price fixing might work in the short term for very minimal amount of time, but overall, it usually does not work. You can't just force prices to go down. But they didn't raise rates in the 40s. Then we had really stable market. Then inflation took off in the 70s. Oil crisis was huge, energy costs, recessions, and you saw this massive increase. And people say, well, we increased interest rates, so that caused inflation to go down. Well, the same thing happened in the 40s, and actually, if you see it, it was higher inflation that went down faster, and they actually had a price decrease. They had deflation here, but they didn't raise rates. So how can we just assume that rates were what caused it in the 70s? And here you can see too, right? We didn't have any deflation. We didn't have prices decreasing. We just had lower inflation. And in fact, it took a long time to get that low. And here we've had the lowest inflation we've had for decades, and it's been with the lowest interest rates we've had in decades. And so why do I think that is? Well, first off, I'll show you. Hold on, we're going to talk about them in a second. There are a couple studies I found that do say they believe raising interest rates raises inflation. And this has been kind of my theory in that when you raise interest rates, you raise the costs of everything, right? And people won't deny that. People aren't out here saying, no, that's not true. They agree with it, right? As a company, I think 497 out of 500 Fortune 500 companies use debt. Most companies use debt to produce things. And even if they don't use debt, the companies they buy stuff from almost always use debt. And if the federal fund rates goes up, interest rates go up, the cost of that debt increases. So the cost to borrow money increases. That means their cost to produce goods goes up. And if your cost to produce goods goes up, unless you have huge margins and tons of room to, eat that cost increase, your prices have to go up. So in reality, you raise interest rates and the price of goods raises too. If the price of goods raises, that means inflation is going up. So how is it that raising your cost of goods by raising interest rates will somehow make those prices go down? The only way is if the economy is so shattered and destroyed that people can't buy these items and companies have to stop making them and lay off people or sell at a loss. And it just, to me, that is like the worst solution ever. And what else is very interesting is right now we have lots of supply chain issues, right? Almost no one can deny that we don't have supply chain issues. That's a lot of what's causing this inflation. We can't get, computer chips. We haven't been able to get lumber. The shipping lines are just clogged up and we can't get shipping, stuff even in the United States with trucks and trains. Everything's backlogged and more expensive. It's all costing more. And that's not because interest rates are low. It's because, of COVID shutdowns, of different things that happened, and that just has snowballed into this massive problem where we can't get enough goods. Well, if you want to increase the supply chains, if companies who work in the US want to now say, hey, it costs us too much money to get stuff from China, we don't want to wait 12 months, we're going to build our own company to produce this. Well, if interest rates go up and the cost of money goes up, now all of a sudden it gets way more expensive for them to build their own facilities, to invest money into their company. To make things cheaper, it costs them more money. So instead of expanding, they retract. And by retracting their investment, their facilities, they produce less. You produce less, they can actually raise their prices, still make money, and absorb those costs because they're not relying on as much demand. So demand goes down, prices go up, inflation keeps going up as well. So that's my theory on why raising interest rates actually increases inflation and doesn't decrease it unless you absolutely destroy and annihilate the economy to a point where nobody can afford anything and those companies go bankrupt or they have to sell at a loss. And then it still seems to be only a short-term solution. But if interest rates were low, that would actually encourage people to invest money, to borrow money, to build more facilities, to produce more, because in business, it's like, scale allows you to sell for less. Look at Walmart. They built this massive business. They can buy all these products at massive scale, pay less for them. And by doing that, they can sell stuff cheaper, right? It's not because they have one store that they can sell cheaper. I own a small grocery store. Our costs are crazy high compared to what Walmart can do because Walmart built to scale. They have all these products they can sell, all these companies they work with. Well, if you're retracting and reducing what you can buy and it costs you more money to buy all those things, all your costs go up. It just increases things. It's not decreasing your costs or driving prices down. And here is an actual study that kind of backs up the same thing. How raising interest rates can cause inflation and currency depreciation. Exactly what we're talking about. And it kind of goes through this saying interest rates can cause inflation and currency depreciation because all of the costs go up. And they kind of say this, people haven't really thought about this idea because they all just assume that raising rates decreases inflation, but they haven't actually thought about what actually goes into inflation and what causes it, and that a lot of people might actually be wrong about it. So I won't read this whole study, but there's other studies I've found out there as well. There's one I keep trying to find and searching on Google, even other search engines. I found it once and can't find it again. Is a study that says raising interest rates has been caused massive inflation in emerging markets. Not decreased it, increased it because all the costs go up. So what we see in a real life example is Argentina, which as you can see, Argentina hikes rate to 69.5% as inflation surges to 30-year high. And inflation has been going wild in Argentina for years. It's not something new. It's not like it just jumped up all of a sudden. Argentina's economy has been horrible. They've been struggling. Their housing is one of the most unaffordable in the world because mortgage rates are so high, because their interest rates are so high. I've talked to a number of people from Argentina. They say it's just crazy what's going on there. And what they keep doing over and over again is as inflation goes up, they keep bumping their interest rate over and over again, and 70% inflation. It's not working. So I would think eventually, after a certain point in time, maybe you'd think, okay, just raising interest rates and destroying our economy, destroying our people's economic lives is not working. Maybe we should look at something else. Maybe it's something else that's causing this inflation, not interest rates, and we should fix that instead. So there's that, and then something else that's really interesting too is Turkey. Turkey has decided, my picture might be covering it, sorry. It says, Turkey cuts interest rates as inflation reaches 80%. Again, Turkey's always had really high inflation, and they've always raised rates to combat it. Right now, interest rates were at 14%. They cut them to 13%. So Turkey, on the other hand, has looked at this and said, wait a second, we keep raising rates. Our inflation keeps going up. Like, it's not fixing it. Maybe it's not interest rates that is helping drop inflation. Maybe it's making it worse. We're going to cut interest rates. And they have been criticized like crazy across the world, saying it's just going to cause rates to go, or inflation to go higher. They're really dumb for doing this, but they've stuck to it and they keep dropping their rates. So it'll be really interesting to see what happens in Turkey, because they're starting to look at things and say, hey, every time we raise rates, it makes things more expensive and inflation goes up. If we drop rates, maybe it will make things go down. The costs go down. It'll give companies more money and be able to borrow money and increase their supply lines and increase their productivity, which in fact will keep prices more stable than if they have to keep shrinking productivity and keep shrinking supply. Then they have to raise prices to make up for it. So we'll see what happens with Turkey, but it kind of, in a way, backs up a little bit of my idea that, hey, increasing interest rates might not be the way to fight inflation. Maybe it's actually making it worse. There's a study that says it might make it worse. There's other countries starting to say, hey, maybe it makes it worse. And then we see countries that have been raising rates for years and years and years, and it is not getting any better. So maybe when they raised rates before, there was some correlation to what happened, but it's possible that wasn't the reason inflation went down. It could have been the other reasons, like gas prices stabilizing, food stabilizing. We never did see prices go down. They just kind of stopped going up at a slower rate. So we'll see what happens. But there's my crazy ideas. I'm guessing the Fed will just keep raising rates if inflation keeps going up. But as we see right now, energy costs are coming down a little bit, but it's not because of interest rates, it's because of other issues. And the cost to build houses has increased because of interest rates, because everything's getting more expensive. And builders have said, we're going to stop building because rates are too high. And that decreases inventory. If you want prices to go down, you want inventory to increase. Decreasing inventory causes prices to keep going up. And we saw that in the 70s as well. People think the 70s were, this horrible real estate market because of inflation and crazy interest rates. Housing prices tripled in the 70s. They went from like 22,000 to almost 60,000. Not quite tripled, but came really close because the cost to produce, inflation, caused prices to keep going up. And builders aren't there to lose money. If their costs go up, they're going to charge more money, or they're going to stop building. If you stop building, it lowers supply, which increases your costs. All right, we'll see what happens. Again, love the likes, love the shares, love the comments. You can tell me I'm crazy. That's perfectly fine. We'll see what happens here in the future. But with interest rates going up, I don't think that's really helping inflation any. I think it's many other issues that we need to work on first before rates, and we'll see. All right, thanks a lot. We'll be back soon.